Hello, and welcome to The Big Picture, the paradigm show where we talk about macro markets and micro market structure. Today I'm joined by my unbearably talented co-hosts, David Brickell, our resident macro expert, and Joe Croy. How do you say your name, Joe? Is it Croy?
Yeah, you've been butchering it the past month, so I might as well correct you now. Krui. It's Hungarian. Okay. I think there's maybe 5 people on this planet that share that last name. It almost sounds like there should be, it's spelled K-R-U-Y. There should be like those 2 dots, the umlaut over the U, but
yes.
Not the case.
So is it, so let me say it again. Is it Krui?
Krui, exactly.
Krui, okay. Joe Krui, our master of flows. I'm, of course, Justin the intern, and I have no special talents, just an ordinary desire to live like a human being. But we have lots of interesting things to talk about today. So instead of me rambling on, Joe, why don't you walk us through what you have for us?
Yeah, absolutely. Well, it's kind of interesting. I'm back home. It's December, and funny enough, I used to work in equity options, and I always find myself comparing my experiences there to the ones that I now have in crypto options, and before December expiry, which I think is right about now in equities, this is like the busiest time of the year. Like I'm sure David's heard of it. Oh, the December quadruple witching, and like this very overblown phrase that people use, happens 4 times a year. And effectively it's just when, the index futures, the index options, single stock options, single stock futures, it basically expire at the same time. So it's like December expiry is always very, very busy on an investment banking desk, which is where I worked on their equity options desk. And you have all these big hedge funds and asset managers that are rolling their positions out the curve, and the largest amount of expiring equity options is always in December. It's just the way it is. And this year is certainly no exception. So I wanted to take a look. I'm like, is crypto following suit? There's a lot of similarities between equity options and crypto options, but then there's a lot of comparisons that you make where it's like, that's not really actually that fair. So let me just share my screen here.
Just as well, on that, why does everyone get so excited around so I kind of get why there'd be a lot of volatility around it, but then people start drawing lots of conclusions about expecting big moves once we get through that expiry. Is that just because, I don't know, the strikes that act as an anchor to the market, and then we get through that?
There's certainly an element of that where look, a lot of people need to trade, but then also you always hear in equity options, we have this big chunk of gamma that's expiring, and it's always the case that quarterly expiries for options tend to be the have the highest open interest in dealer exposure, right? So it's we have all this long gamma expiring, long gamma that was potentially keeping that market anchored, as you mentioned, as market makers need to hedge and readjust their delta exposure as the market moves. Well, the way that works is as they readjust their rebalance their delta, they actually end up muting market moves in both directions. So as the market is rising, you have market makers that are selling into that strength. And then as the market is falling to rebalance that delta, they're actually buying into that strength. And then as you guys know, as you get closer to expiry and you closer to, the act where most of the strike exposure is concentrated, that is when you have the most gamma exposure. So people talk about, okay, when we have a lot of gamma that's rolling off the board on December expiry. Oh, maybe this is a catalyst for the market to start moving again, right? So this is one of the big reasons why people talk about it, at least from an options perspective. But I agree with you. There's a certain element of this where it is a little bit overblown, and a lot of it is kind of wishful thinking. I remember when I started in the business back in 2017. This is when realized vol and S&P was 10 or even lower. People are like, oh, okay, we have all this gamma expiring because people were just hammering vol systematically and getting dealers washed with gamma. Oh, okay, maybe this is actually a catalyst for the market to start moving again. So yeah, that's kind of the context there. Let me share my
TradFi were the original degens. They don't like to associate with it, but they'll jump on
definitely not
any move.
Definitely not to the extent in which we are. That's why I got out of that. Give me a second. As I was mentioning, December expiry is always the busiest in equity options. So we wanted to look at it in crypto as well and kind of see, what's the story here, right? And the results are like pretty surprising, right? So if you look at it here, so like this, these yellow ones down here, Bitcoin open interest rolling off, and Ethereum open interest rolling off. So 55% of Bitcoin open interest and about 51% of Ethereum open interest is expiring by the end of the year. And of course, most of that is going to be concentrated in the December 30th expiry, which is, the standard end of month expiry for crypto. So I looked at these numbers and I'm like, Jesus, that seems like a lot. Like, as I mentioned before, I kind of use my experiences in equity options as a barometer for how I would view crypto. And like some of those comparisons that are kind of fair, some of them are not fair. But I thought, I was like, damn, that is quite a lot of open interest that is expiring in the next couple of weeks. And like, is this going to be replaced? Right? Or is like the open interest just going to completely fall off a cliff as we get into the new year? So I compared this to S&P options open interest, and I'm sure David can lament about this as well. Like not having access to a Bloomberg anymore is certainly a big pain. So I went on the internet the old-fashioned way, and I pulled up an S&P options chain, and basically downloaded all that data to Excel and looked and to try to determine how much S&P option open interest is rolling off the board, and then comparing that to what's happening in crypto. So in S&P, only 28% of the option open interest is rolling off. And you'll see here, I'm only using data from December 2022 to September 2023. I'm only looking at those expiries kind of just for an apples to apples comparison, because these are the expiries that exist in Bitcoin and Ethereum, right? So 28% of S&P open interest is rolling off by the end of the year, which is about half of what is rolling off in crypto. And I looked at this data, I was like, Jesus, like that is a massive difference in the cryptos versus equity open interest. And what I wanted to do, like I was like, why is this the case? And David, I'll ask you, not to put you on the spot. What do you think is the big reason?
Why the crypto open interest is rolling off so much larger than
yeah.
Well, I mean, I guess it's just that. Well, partly being a smaller market in a way. So I guess these periods can be exaggerated, but I'm assuming, obviously, post FTX and everything that's gone on, there's just been a lot of risk that's been taken down. We've got some existing stuff that was probably put on a while ago that people will run and that roll off.
You're barking up the right tree there.
Is it coming from the ETH merge?
Yep. It's all merge trades that are expiring worthless. That's the reason why the open interest is massively falling off. So like I'll move to the next slide here. One sec.
That's actually crazy.
Right? So if you look at the largest trades that went up on Paradigm between the dates July 15th and August 15th, it is absolutely staggering. Like David, I can imagine like the amount of conversations that you were having with your customers, like, oh, we have this big upside merge trade, everybody's getting super bullish. I mean, you could certainly argue that a call fly is not too bullish of a trade, especially when, the strikes are as wingy as they are, as you see on the screen, the March 3,500, 4,000, 4,500. But regardless, there was a ton of these upside structures that were printing in the market in the run up to the merge. And these structures, because like a call fi is a four-legged structure, right? So like that March 3,500, 4,000, 4,500. Well, in this case, I'm buying, in terms of ratio, buying one of the 3,500. I'm selling two of the 4,000, and then I'm buying one of the 4,500. So this quantity of 87,000, when this trade prints, in aggregate, it's actually adding 87,000 times 4 in terms of open interest. So what is that? 87,000 times 3, I think 348,000 contracts are added to open interest just as the result of this one call fly trade, right? So that one happened in March expiry, but we also have it in December, like this D's 2,600, 3,000, another upside call spread that was bought. You know, the December 2,500, 3,000, and 3,500, right? So 280,000 roughly contracts are added to open interest. Whoops, sorry, you can edit that out. Are added to the open interest as a result of these trades, right? So, and after the merge, so we saw all these massive upside structures in terms of numbers of contracts being added before the merge. But then the merge proved to be a non-event, as we know, with the spot action. But we only saw a little bit of unwinding of these positions. You know, there was some chips that were taken off the table once it realized that, you know, Ethereum wasn't going to moon as a result of this merge. You know, it was very much a sort of sell the news sort of event. But most of the open interest actually remains outstanding, and this is why the December open interest is completely bananas, you know, compared to every other expiry. So if you just look here,
what surprised me a little bit on that, Joe, is like if I remember back to when all those trades were being put on, there was also like a lot of March dates put on, right? March expiries,
exactly.
Same sort of trades. So I'm surprised that there's not a higher percentage of, a higher sort of level of open interest still out there for those dates as well. But
there is. Here, look, I'll go back to the first slide. Look at it. So here, Ethereum open interest, right? So 46.5% is in this December 30th date, which is where all these call spreads and call flies are printing. But look here. Do you see it this March?
Yeah.
Are you able to see my? Are you guys able to see my mouse?
Yes.
Oh, okay, we are. Cool. Right. So in March, right, that is the second highest open interest. There's 1.3 million contracts out there.
Yeah.
And in 25% roughly of those contracts are driven by this one trade. This March 3,500, 4,000, 4,500, because it's 87,000 times 4. A call fly has, 4 legs when you include the ratio, right? So 25% is just driven by this one trade. And then look down here, ETH call fly, March 3,500, 4,500, 5,500. That's another 240,000 contracts just from this one trade. So you're exactly right. The open interest in March is also massive. Does that make sense?
Yeah, it does make sense. So what does it mean, Joe, then? So we get through this, all this open interest rolls off. What does it mean?
So what it means is that the open interest is about to fall off a cliff, right? So if you just look at this is a chart from GVol or Amber Data. And so the two highest open interest strikes are the bellies of the call fly, right? So that December 3,000 and then that March 4,000, right? And look, these are way out of the money. Like these are way out of the money trades. Like we're talking a December 2,500, 3,000, 3,500 call spread. Like we're 50% lower than the lower strike, right? So we're not expecting these large December call flies to be rolled, right? And alongside this call fly position, right, or specifically these December 3,000 calls, there are 280,000 contracts out there from other strikes as the result of merge trades. Like we did the analysis that are going to expire worthless. All these strikes up here, right? Like these 4,000, 5,500. These were all put on pre-merge, and clearly, the open clearly we're nowhere near, the strike price is there. So a lot of these trades are just going to roll off completely worthless. And the Ethereum open interest in the next 2 weeks is going to fall by at least 500,000 contracts, just as a result of merge flow.
So for a smooth brain like myself, when open interest falls off at this rate, and all these expire worthless, what impact could this have on the market?
In terms of like direct impact on the market, I think it's just going to show that what we've seen, it's basically just going to bring the open interest back in line with like the volumes that we've been seeing over the past month. And the volumes are very light, because it's very easy to say like, oh, okay, yeah, like this is great. Open interest just keeps going up and up and up and up. And sure, that has been the case through December 2022, as shown in this chart right here. But what's going to happen as we get through December and March, the open interest is going to fall off a cliff, and then you're going to be like, okay, I guess that makes sense given the amount of volumes. So it's not really an analysis in terms of like, oh, like what does this mean for like spot action or these things? It's more so just kind of talking about like the state of the market, and this is where we're at.
I guess you could argue, firstly, given that a lot of open interest and those expiries are so far out the money that they're not having any, they've basically got very little gamma attached to them, so they're not having an impact.
Yeah, not just gamma, just like just a lot of other like Greek exposure, kind of like second order Greece exposure that, is just pretty meaningless at this point, unless we start to rally a little bit.
Yeah, and I guess through that, if open interest is low, if there's generally sort of less gamma and stuff in the market, then I guess like, if for want of a better word, then sort of spot trading is a little bit cleaner, because you're not kind of being impacted by dealers managing gamma and stuff like that, which we don't want to see from our point of view.
Yeah. But the thing is, this is why I would like to get like somebody, one of our like big like market making traders, on this podcast with us, because then they can actually tell us like, look, this is just like my opinion in terms of like what market impact, but getting them on there, and they might have a different opinion and be like, well, actually, like, sure, like these March 4000s, they're really far away, but like we do actually have a little bit of impact. We do see a little bit of impact from this like outstanding open interest. Like, I can't really answer that question compared to a market maker that's in the weeds, kind of rebalancing their risk around like this position that they've put up. But yeah, so like the reality is, so like we calculated merge trades positions represent right around 25% of the total Ethereum open interest when you include the December and the March exposure. And that's not even counting, the dealer hedges of this flow that is also going to expire and lead to a further decrease in the open interest. So the main point is, I would expect that these open interest, this open interest chart towards like the beginning of the next year to really start trending down a bit. But this isn't me being like a crypto options doomsayer. I know the tone of this podcast has been a little bit pessimistic, and I guess rightfully so, given everything that's happened, with FTX and the interdealer flow analysis that we did last week, that we all agree is not great for the market, of course. But it's certainly our view at Paradigm that this is a temporary phase for the market, and to be honest, it's my view it's going to persist as long as spot trades range bounds and participants feel this discomfort around this centralized exchange exposure, which hopefully can start to diminish, just with time. But my view is crypto spot, it just needs a catalyst in order to get excited, whether that's a central bank pivot or some crypto specific narrative. Like we saw how much option volume that the merge drove, right? We had this big catalyst for Ethereum, and we saw this insane amount of upside flow that was trading ahead of it. Again, 25% of all the Ethereum open interest were what quote unquote merge trades. We see the volumes that events like this can bring, But when I look forward into 2023, like, what is that story? I just don't see one. Like, are we going to be really, relying on the macro here, or are there also crypto idiosyncratic things? Like, there's on the Bitcoin side, I'd say it's more kind of a structural overhang sort of story. I know people talk to death around like Mt. Gox and these sort of things, but in terms of like a potential positive crypto catalyst, I don't think I see one really next year.
Yeah, maybe the unlock with ETH.
Well, we'll see.
I mean, that's kind of sort of split opinion in terms of what that means for ETH when that happens. I do think as well. I mean, like, to your point, there is a lack of narrative right now, I think, in the market. I mean, we're kind of crippled by fear. But I kind of think, and I know I've kind of been banging the drum for the last sort of few weeks in terms of like this macro regime shift. But I kind of think when you're experiencing the regime shift, you end up in this little no man's land for a little bit where we kind of lack in the narrative, because kind of like the price action's not really matching that kind of shift. The pushback that I've been getting, and even obviously you had Greg on last week, and that was interesting. But that pushback around, this sort of tightening cycle, and that's going to keep weighing on price. Again, I kind of think it's a 2022 story, and it's been and done. But we're not yet at the point to have the catalyst for people certainly not start getting bullish. So I kind of think like we need, maybe another really weak CPI print or something like that, or something to happen that the Fed start changing. Because equally, other than like the kind of idiosyncratic sort of crypto blowups we're seeing, it doesn't feel to me that we've got a macro catalyst necessarily for the downside at the moment. But yeah, I get it. Price action looks pretty shit. It's not really, no one kind of really wants to sort of buy this dip. At the same time, it's like people don't really want to sell it. And we spoke about vol last week. It's difficult to sell vol down here, but then who wants to buy vol? So we're kind of in this no man's land where we're just kind of drifting. And yeah, we need a catalyst. And hopefully 2023 brings it. And markets tend to flip pretty quickly. We certainly know that in crypto, right? But also in macro, things change like pretty rapidly.
Speaking about catalysts, can you walk us through what happened in Japan yesterday?
Yeah. Say just when we thought we could all like completely relax, obviously Bank of Japan came out and surprised the market by tweaking their yield curve control. And the more I sort of look at it and think about it, I know we all try and read into everything that central bank does. It feels like they're sort of tweaking policy. I understand people are saying it's setting up to actually start embarking on a tightening cycle. But effectively what they did, right, they had their yield curve control where 10-year yields were capped at 25 basis points, plus or minus. They widened that to 50, and obviously immediately JGB sold off, and 10-year yields in Japan went towards, I think they got to around 40 basis points. And then the rest of the market kind of reacted to that. I spoke briefly yesterday when we put out some quick thoughts. The reason why Japan's so important, it's one of the largest capital exporters to the world. So got huge excess savings in Japan, and those excess savings go and invest in assets around the world. So when there's a change domestically at home, the fear is always that they'll sell their foreign assets and repatriate that cash back home. Japan is also the largest foreign holder of US treasuries. So obviously, potentially, it's a big move when Japan have reasons to adjust their portfolios away from treasuries back to JGBs back home. So we saw equities initially knee-jerk lower. We saw treasuries sell off. And treasury yields went towards just above sort of 370. Now, I guess the fear is now, does that now spark this big sort of portfolio reallocation away from treasuries back towards JGBs? And then obviously treasuries start selling off, yields start going up. then that starts to blow up equities, and then also the potential for them to start selling equities as well. My view on the treasury side of things is that I don't think that's a huge sort of risk at the moment. The main reason being is that hedged treasuries. So if you hedge out the FX risk back to yen, given we've got this inverted yield curve, right? So the sort of front end impacts your hedge, like the cost of your hedge. So hedged treasuries back to yen were yielding negative anyway. So if you're Japanese and you're buying treasuries and hedging out the FX risk, you're actually yielding negative on the treasuries. So they weren't attractive to hold in a way. And consequently, throughout the year, the Japanese have generally been a net seller of treasuries. So I don't think that's a huge change to the flow dynamic that we've seen all year in a way. So I don't think it's something that's going to spark sort of huge selling of treasuries. So I kind of didn't feel it's such a big deal in that sense, but I understand why sort of the market reacted. And I guess it feeds into this theme that central banks around the world are playing catch up with the Fed. We saw a more aggressive ECB last week, who are also talking it up. But this kind of positive side for me that I kind of highlighted, I'm still bullish treasuries for the three reasons that we've spoken about before: peak CPI, peak Fed. We're near the end of that hike cycle, and also we have growing sort of recession and growth fears. So I think they'll continue to weigh on treasury yields, and will come lower. And there's some quite sort of solid technical levels that I've kind of been looking at. I know Anand's not keen on technicals, but sometimes it's good to watch. I'm not a big tech guy, but they can sometimes be self-reinforcing. So we kind of bounced off the levels that I thought we would at 372, and the bigger one is 380. So I think we'll continue lower. The other thing that I think is interesting is this kind of policy convergence trade now that we're seeing, where other central banks are converging towards where the Fed are at. And what that's starting to do is to weigh on the dollar. And as we know, the dollar's been the wrecking ball that's kind of, strangled risk assets throughout the year. And that's starting to ease. And this actually in some ways feeds into that. So I kind of had a more positive take on it, because if I'm right on treasury yields, which I think are going to trade kind of idiosyncratic to what's going on in Japan, and I think they come lower. If the dollar comes lower as well, then that's not a bad outcome for risk. And I kind of think that's why equities have actually bounced since that initial knee jerk. And treasury yields have recovered a little bit without any particular follow through. But yeah, it's everyone's always nervous about the Japanese market. I think as well, like it doesn't really trade now. Like the Bank of Japan own that market, so it's not really a market anymore. So the historic significance of it, I don't think, is so big now. Again, not to underplay the importance of Japan as say a capital exporter to the world. Like if the lifers in Japan start shifting portfolios about, then it's going to have a big impact. But I'm not sure if 25 bips is going to be the thing that makes them want to bring all the money back home.
Yeah, like I hear you here, like on your rates analysis, but like I think it's more so in my view, just like about the implications here, right? Like the the country that has held off the most in terms of like removing easy monetary policy is now starting to get away from that, right? And when you do the first hike, right? Then you're just opening up more opportunity now to do even more hikes, right? Like the precedent is completely set there now, right? And so if you're going to, like, I was reading this Twitter thread, and they're like, okay, if you're now going to this world where like now you can actually have real returns, then like maybe those Japanese lifers do get their money out of equities, bonds, what have you, right? The massive Japanese asset managers that have a very, very large portfolio allocation to U.S. equities, these guys start moving their money back to Japan, then, crypto, I can't imagine, is not going to be prone from this. Just because, crypto has such a high high beta, right, to what's going on in the equities market. So I guess that's where my concern lies is like, okay, if the money starts going back, then, that could be a problem, right? And the thing is, these carry trades are, from what I understand, can be pretty highly leveraged, right? So like 25 basis point move, it doesn't seem like a lot when we talk about it, but like can actually be quite painful. And if you go another 25 bips, then, it gets even more painful. And then this is kind of like a reflexive, self-reinforcing thing where potentially capital, gets repatriated back to Japan. And then, you have asset sell-offs because of it. Look, I'm not an expert on the subject by no means, right? Like I worked on an equity options desk, but like, to me, this kind of seems to be the risk where, money is going back into Japan and these Japanese asset managers kind of just selling out of everything. And then that has a follow through to the crypto market.
Yeah, I get that. The one thing I would say as well, that the big flows come from the Japanese lifers, right, and the pension funds, and they're slow moving animals, right? They're not like a hedge fund that's gonna just kind of, a bit of data comes out or there's a change and just shift too quickly. I mean, these guys like pre-announce often like their plans in terms of hedges and things like that. So I don't think that happens particularly quickly.
But if it's like more of a structural shift over time, right? I'm not saying it's going to be like a violent unwind, but if you kind of have this structural overhang where like these guys are raising rates and then money's going back to Japan, then, that's going to potentially put pressure on asset prices. And look, maybe I'm overblowing it.
Yeah. And the other thing to me as well, it's not clear that you want to be moving money back to Japan if they're going to sort of tighten rates and slow the economy. Like you don't want to hold JGBs if you think JGB yields are going higher. You want to wait till they're actually up there, right? Like if you go and buy JGBs now, call it 50 basis points, and you think they're going to 100, why are you going to go and hold them? So yeah, I get the reaction. I still think the only game in town for me still is the Fed. And that's kind of where my focus is at the moment to kind of stay with that. Wary and watch for what's going on in Japan. I mean, they did stress that this is not a tightening move or what have you. It's to smooth. Yeah. And I get that, and a smooth market. I actually think there was a big part that was aimed at the currency and to strengthen the currency. But yeah, so, and it all depends as well. Like if you think about equities, a lot of it depends on how well hedged they are, like currency hedged they are. If you're unhedged and you're seeing yen strength, and then either you're going to rush to put on the currency hedges, or you're going to sell out your equities because they're losing value back in your domestic currency. But I think hedge ratios, they're typically sort of reasonably high. So. Yeah, I'm not as concerned as what a lot of other people seem to be on that. But yeah, I mean, if it develops into something more, and I guess the bigger fear everywhere is like this is feeding in that sort of global tightening. ECB are doing it. I mean, the one thing I do think is the two most dovish central banks for the last 10 years have been ECB and Bank of Japan, and it would just be something kind of poetic almost if they were the ones that essentially called the top in this hike cycle everywhere, and also in this inflation sort of cycle that we're seeing. And I've kind of got a sneaky feeling that's what's going to happen. ECB have definitely got formed for hiking at precisely the wrong time. It feels like maybe they're all going down that route.
Cool. So I think we're coming up on our time here. So Joe, closing thoughts.
Closing thoughts, main takeaway from my standpoint is that the open interest, I think, over the next couple of weeks, especially as we get through December 30th expiry, is going to completely fall off a cliff for the crypto options markets, and then potentially happen yet again in March as these merge trades roll off.
Joe, David.
Yeah, I guess my closing thoughts as we sort of come to closing out the years, it's been such a bruising year. It's been a tough year for everyone. And the sort of drivers for that, the main driver, aside from Luna and now FTX and all these, idiosyncratic things that have really hit crypto. Obviously, the macro has been a big driver of that, and essentially we've had to ride out the sharpest sort of Fed hiking cycle in recorded history, and a massive drain in liquidity. And that's hit not just crypto, but equities and other risk assets. I think that tide is turning into 2023, and I think the path through 2023 looks easier. So happy to shut the book on 2022 and sort of recuperate over the holiday period. And I think 2023 looks a better year. So I will enjoy celebrating Christmas and look forward to what the new year brings.
I hope you're right.
Yeah, and just as a final note, we will not be doing a show next week, given it's the holidays. So thank you guys for watching. We'll see you in the new year.